Good morning, everybody. Currently, not 5:42. It is, but it's 9:50. I don't know why that's not incorrect. Nevertheless, this is day 101. So, yeah. As you know, my goal isn't to get the most views. It's not to go viral. You know, all those things. I'm simply here just to show you the real raw footage of me just learning. And we're currently on day 100. And 101, sorry. And just to give you guys an update. So we've learned the ICT Mentorship 2022 and we have established it. We've invested a certain amount of money. We 10x'd it. From 10x'ing it, we then lost a lot to the point where from the beginning, it's like 3x. So imagine we invested 100, we took it to 1,000, took it down to 300. So I've now withdrawn that 300. Excuse me. So I've technically made profit. And the reason why is because I'm starting to get into bad habits, which are not part of the rules that we established in the learning of the mentorship. And specifically, I need to know when is good to enter. That's where I'm struggling with. Because the entry model, I think I've mastered pretty well. I'm pretty good at it. And I'm going to, oopsie, my hand slipped. I'm going to put some work into fixing that, of course. I never like to have a weakness and keep it there. So I was able to find out, first of all, that it was a weakness during the process of reflection, seeing the pattern of price just going the opposite way. Now, that's largely due to where to enter, the characteristics of when price is ready to be entered, and then 3, the daily bias again. I think I need to get better at that because by having no targets, I'm very when, for example, price is consolidating, I really learned that you have to look for on the smaller time frames liquidity pools more so than the kind of daily range when it's a bit unclear. And that's something I wasn't utilizing. Number one. Number two, I've been mainly not looking for liquidity sweeps. Now, Euro GBP, I think it was the smaller time frames. Was Euro GBP even? It was. And it's actually larger time frames. You can see here we have these lows. It's going to mark this one because it's equal with this. So this is an area of support that retail will see, which means this is a target for where smart money would see. So if you notice, this is from last week Friday, we had this high over here. We swept above it. And then after that, we had this market shift downwards. Now remember, your target would be these equal lows. I probably would have targeted this one and this one, right? I don't think I would have targeted this. Targeted around here anyway. And you can see that obviously on the larger time frame, we had a big drop. But on the smaller time frame, during the London session, took out Asia lows, rallied up higher, all the way up to almost equal highs. But we came up to kind of this kind of area here. There's also an order block up here. This is the high of it. And then we dropped downwards. But after the sweep, start from here. After the sweep of the highs, we broke structure downwards with a displacement here. To be fair, I probably would have been stopped out actually because I would have set it to above the first candlestick contributor. So I actually would have been stopped out by this wick right here. So I actually don't think I would have been able to get into this. I'm not gonna lie. But the idea is what I'm looking for, which is this high here got swept, and then the market structure happened. Albeit that is one high. That's why I need to know what is valid, because price can do this from an order block. It can do this from a fair value gap. It can do this from just a liquidity sweep. It's important to know which one it is to the best of my ability, which can obviously be difficult when I don't know what's valuable or valid to enter. So there was this something I need to change. Give me a second. It's something I saw. It was a how we made our own notes. Somebody else made their notes, and they shared their version of the ICT mentorship. I need to check something really quickly. I forgot about that. Okay. So it was the ICT mentorship PDF. I was on Reddit. I saw. I don't know if it will show up here. I'm gonna blindly don't download it yet. I think it was this one. Yeah, it was. These ones I'm not sure about. Let me see. We're gonna go through it. I prefer having it like this, where it's written down. It just allows me to, because I've already watched the video like multiple times. I'm mainly trying to find out the core. I know what I'm looking for basically. It's not like a thing of I'm learning something new. I'm generally just looking for. Wait, my mentorship. Is this his version? Let me see what he's doing. Let me see how this person made their notes. Okay, so I'm gonna go through this one first. And this one has other ones as well. That, for example, the silver bullet. Not sure what that is. We're gonna go through some of these. Literally, what I'm gonna do is just be reading because there's no point in me analyzing the markets if my current method isn't working. So I need to kind of hone it in a little bit. See, look, this is something that I didn't enter this on my demo account, but I was expecting this to go down. My reason is for this going down, where the fact that this is my target, this black line on the daily time frame, I believe. It's the low. We haven't reached it yet. We are bearish. Yes, it's plausible that we come up to this balance, but I think that it would probably take this liquidity first. So that's my storyline from the daily time frame. And you also had the fact that we were creating consistently these market structure, and the market structure had these lows and these highs all in sync, lower low, lower low, lower high, lower high. So I felt that that pattern will continue to the point of this. Now, yes, there was this imbalance, but guess what? It got filled instantly. So if we feel the bullish imbalance, yes, there's liquidity resting above here, which is not that strong, but there is technically liquidity. Maybe I could have waited for that, but I just thought that okay, we haven't come above this. We haven't come above this. We shouldn't come above this. Now, the only thing I can see now is that these highs are not really into medium term highs. Maybe this one you could argue is, but the rest, this isn't, because it's not the high that filled this. Maybe it is. I don't know. See, that's what I'm saying. There's little nuances. Like I know that the intermediate term highs, when you're in a, let's say bearish, because we're looking at bearish chart, if you're in a bearish market and you have a retracement, and that high of that retracement is a filling of one of the fair value gaps. For example, if the price was to come up here, price shouldn't come above that whilst we're still bearish. Why? Because we have rebalanced that fair value gap. So then you can use that when it comes to entry, when you're, for example, utilizing a stop loss and you want to set it to a zone. You don't have to set it to the highest zone. You can say, well, the high of this intermediate term high shouldn't be broken because of the fact that price went rebalanced. So intermediate term high. That's the nature of it. And so now this technically just about wicked in. So this classifies the intermediate term high is a question I now have. And then this here, this is a fair value gap here. It filled it and it went higher. Does that classify as the intermediate term high? Anyway, let's get back to the notes. So I like the layout of this one a little bit. So I'm going to start with this one. So this is the ICT mentorship overview from 2022 to 2025. So they including the model from 2023's, 24 as well, etc. Now, we have the idea of the lingo. So I'm going to do my best to read through this. If we get too overwhelmed, I may either switch over to something else. I just prefer it as like a book rather than a video all the time, because a video, you can't really look at the words. They're not stable. They are changing, because you have to then listen to the speed that the person is talking and receive information from their kind of point or a skill set, which is sometimes I need to look at things longer, sometimes I need to hear it quickly, you know. So at least I can control that when reading. So enough with this. Again, like I said, wait, there's be 3 pages here. Okay, we're gonna start with this just to see the difference between all the ICT mentorship. So this document summarizes. That's in Britain American. Okay. Or you can highlight and ask questions. Hold on. Okay, it's premium fair. The document summarizes the major concepts, strategies, and evolution of ICT Inner Circle Trader mentorship from 2022 through 2025. So the core concepts of ICT is market structure, liquidity pools, fair value gaps, optimal trade entry, institutional order flow, premium versus discount, Judas swing, dealing range. So I have a fairly good understanding with all of these, albeit yes, we are fairly new. I know we probably started this around March, April, May, June. It's probably been 3 months since I started learning intensively and strictly from ICT. And it probably took us like maybe it took us probably 60 days to fully finish the mentorship 2022 full version, not the streamlined version, and study it too, not just listen. Okay, so market structure, high highs, high lows, low highs. That's all good. The only thing you didn't include here is intermediate term highs, short term highs, and swing term highs. Those are the things. But change of character, we understand. Breaker structure, I understand. And of course, I understand those. So look, understand those. Liquidity pools, we understand buy side, sell side. Pricing efficiencies, I understand that. The optimal trade entry, he has it at 61.8 to 79. We have it at 60. No, wait, what do we have? It 602 or something? 62. Okay, we rounded up. But we basically have this. Institutional order flow, we understand the concept of it. That's why we see sometimes when we're in a bearish market, bullish candlesticks are deemed as where institutional order flow gets in, similar to order blocks. We understand premium versus discount. We understand the Judas swing and we understand the dealing range. So the 2022 model looks like the weekly bias, which is the daily and the weekly idea. We're trying to figure out if price is going to go up or down. We're not trying to figure out how much buy, where it's going to go to exactly, how quickly it's going to get to where our target is, or how quickly it's going to go down. We're just predicting whether it's going to be bearish or bullish. That's the first instance of the bias. The daily bias is a directional expectation using AM session. That part I didn't really do. I didn't figure the daily bias based on the AM session. I mainly used it on, or based it on, the daily tape reading or price action. So they use Asia range, the London kill zone, or to determine the New York kind of bias, which makes sense. I've used this once for GUEU. It did work. Risk management. I am going to be in control of this for now. Probably do everything in 10x. So from 2.5 to 10%. Trade journal, yes, we have that. We kind of do it. Power of 3. That was also mentioned in 2022. What else? Ooh, that'll be good. Market shot the shift plus fair value gap plus order block plus liquidity sweep confluence. I like this. 2024 talks about time and price theory. So 2025 talks about integration with AI. Okay, interesting. 2025 piqued my interest. 2024, I would like. Essentially, what I'm realizing from this is that I need all of these in my bag. The idea, though, would be to master 2022. I feel like there's no point in moving on to 2023 until I'm profitable on a consistent matter with 2022. We're profitable, but we have some kind of gaps, which is what I'm trying to fix right now. So we're going to focus on studying just the 2022 model. I do want to have a quick look at the silver bullet because I did hear about it. And just open it. Can I edit it? Actually, can as well. Okay, so this is ICT Silver Bullet Explain Strategy. 10 to 11 a.m. Okay. And this makes sense, right? This is just the entry model. You have the market, the displacement breaking the swing term low, pull back into that displacement area, entering that sell, targeting. Okay. So the ICT Silver Bullet trading strategy is a time-based algorithmic model that involves catching trade entries within specific 1-hour intervals during the trading day using SMC concepts. SMC, like liquidity and fair value gaps. The strategy, which is part of the inner circle's trader strategy, hinges on the idea that the price tends to hunt for areas of liquidity during these 1-hour time intervals. On a price chart, the ICT Silver Bullet looks like that. Wait for a liquidity sweep during the higher time frame. Wait for market shock to shift or change in state delivery into the opposite direction. Wait for the fair value gap to form. Enter as soon as it enters the fair value gap. Stop loss at the high or low of the fair value. gap. Buy side liquidity is just too high. Originally, the silver bullet trading strategy, as described by ICT founder, uses fair value gaps as entry targets to target areas of liquidity such as daily highs, lows, weekly highs, lows, sessional highs and lows. Since he released the strategy, many other traders have tweaked it to fit their trading system. As a result, we have various forms of the silver bullet strategy. The key timings for the ICT silver bullet strategy. So the opportunities to trade a silver bullet strategy come within 3 key timings, and they are, what are they? Hello? Taking the above into consideration, your trade setup and trade entry must happen within any of these intervals before you can consider it silver bullet. Once you get an entry, you can hold your trade beyond the interval. Well, there's no, just jumps from here to here. Maybe there's something meant to be here. The ICT silver bullet trading strategy is a time-based algorithmic model that involves catching trade entries within specific 1-hour intervals during the trading day using smart money concepts like liquidity and fair value gaps. You could trade the strategy on the 5-minute time frame or the 1-minute time frame. ICT founder himself uses the 5-minute, 3-minute, and 1-minute time frames. For that matter, it could be useful to use multiple time frame analysis technique, which enables the trader to view several time frame charts on one or more screens. If you're new to the strategy, we recommend starting with the 5-minute time frame. You'll have more time to analyze the chart and place your entries in the 5-minute time frame. Downside, however, is that you might miss some trading opportunities. As you get better with the strategy, you can move to 3-minute and the 1-minute time frames. So the ICT silver bullet trading strategy, trade example. In this example, we'll be trading the NASDAQ pair. Here it goes. Determine the overall market direction. Once you get into your session, zoom out into the 15-minute, hourly, or 4-hourly chart. At this point, you're looking for the overall market direction because that's the direction you want to trade in. Now, this skill takes a lot of practice to master and can be quite tricky, even for professional traders. So take your time practicing it. In the example below, notice how the price came down for the discount area involved in the 1-hour BISI, which is buy side inefficiency, sell side. Wait, buy side inefficiency, sell side inefficiency. I think. No, buy side imbalance, sell side. I can't remember what that means. Or fair value gap. Plus the sell side liquidity getting swept. Now the smart money is gonna be looking for buy stops to sell at higher price, and at this time the drawn liquidity was at the all-time high. So yeah, you can tell this. I've seen this multiple times where I'm looking for sales, but I know the price wants to go up because it's given the signs. Displacement above the highs here. Yes, it wasn't within this imbalance, which is a reason. For example, like if I had this, I would draw a fib from this high to this low, and this retracement would be an optimal trade entry selling it. So it was. What is this? Moving on to the 1-minute time frame, we can see that after taking the low of this low right here, Nasdaq creates SMT with ES, which makes it high probability setup. After that, price rallies up, forming a fair value gap, which just filled just right after 10 a.m. After we get that, we open a trade, placing the take profit at the all-time high and stop loss just below the bullish fair value gap. this isn't the greatest explained. For example, I mean, this needs to be. What this is missing. Okay, I just wanted to know what it was. Okay, now I have a rough idea of the ICT silver bullet. Okay, we can do a quick review on SMT because I've seen it happen a couple of times. For example, on the daily time frame with GU and EU, I'll never forget this example. So GU, we can see here, created a high high, right? Which looks like, okay, price wants to go down. But what happened? It displaced downwards, taking out this low, pulled back, and then it started to distribute downwards. With Euro USD, we didn't create the higher high. We had the lower high, and then we had this get taken out. So that was almost like divergence. I'll show you with this arrow right here. That's EU. That's GU. This when it shows two correlated markets move out of sync, showing where smart money is likely to take the other side of retail traders. So, example, GU makes a lower low, but Euro USD makes a higher low at the same time. This divergence signals hidden institutional activity, liquidity being grabbed in one market, while retail follows the obvious move in the other. Uses SMT as confirmation for bias entries or potential reversals, which literally was the examples I used right here. EU, GU. You can see that orange line showcasing exactly that. This divergence signals hidden. Yep. So one positive correlation SMT. One positive correlation SMT. So two correlated pairs usually move together, but one makes a different high or low than expected. Example, EURUSD and GBP USD usually rise together, but one lags, showing hidden institutional activity. For example, EU displaced this low on Friday the 15th of May. It displaced this low on the 14th of May. So what's interesting is that GU moved first, EU moved second in terms of the actual swing low being taken, the most prominent one, not the next short-term highs low, sorry, the most swingiest of the swingiest. This one got taken out on the 15th because on the 14th of May, we're still not below it. So on that 15th of May, we took it out. On GU, the swingiest of swingiest lows is right here, which got taken out on this big candle, which is on the 14th, so it's a day earlier. So it's interesting how this created a lower, higher high, but this one displaced the lower low first. So then you would know, okay, well, if I had that bias, I'm gonna assume that this is gonna go down. This day here should have been a very profitable day, in theory. Literally like this. We had the opposite in terms of highs. So it was GU that created a higher high, and then it was EU that created the lower high. I should say higher low, but lower high, right? But it'll probably be best if I do this. So this is Euro USD creating a lower low, which is the equivalent of this being a lower high or higher low. Sorry, created a lower high. This created a higher low. So EU's on the bottom. Obviously, it's inverted. So if I to invert it, you can see that here it created a higher low, like this. Whereas GU I just didn't really like that. Okay, GU created this lower low right here, and then it went up. You can see here, boom, displaced, came back down and went up. Obviously, that created this liquidity. So yeah, it's the same thing, just inverted. So negative correlation, SMT. I think there's a better way to open these, truly, because I don't feel like this is. Allow me to reopen this. Give me a second. PDFs, I should be able to open it in many different ways. There we go. Better. Okay, so negative correlation. So two correlated pairs usually move opposite, but one moves against the expected opposite move. Example, EURUSD rises while DXY also rises. Normally they go opposite, signaling smart money intervention. So if they were in sync, my computer's so hot. Yeesh. If they were in sync, this would have created a lower high because it's basically like a mapping, like a mirroring of DXY. Obviously, it depends which one's DXY, but okay, cool. So using SMT for entry. So you want to spot it, of course. So you look for divergence between correlated pairs, positive or negative, to identify hidden institutional activity. A lot of times when you look at one market by itself, it doesn't show, like this doesn't show institution. This is just price action high created. But you would miss out on this displacement. You may think it's going to continue going higher because of the fact you're not looking at the hidden institutional play that this high is actually not just a high, it's a manipulation of buy side liquidity, and we know that from the way that EURUSD is moving. And another thing to note, remember here, this low we've taken out by a couple of pips. GU, we haven't done that yet, so we're looking for sells on this for sure. Remember, I was looking for sells yesterday, but the difference now is that we have come back into this fair value gap. We've also taken out on the hourly time frame this liquidity, and we've come back down into this range. What would have been nice is if price took out Asia's highs. We took out the lows, created equal highs, came up to the high, and this plays downwards. But I would be bearish. Why? Because Euro, we've taken out the overall target low, and Euro actually took out Asia's highs, then went down, which is what I would have wanted to see for GU, but we just didn't do that, I guess. It's fine. Right, just get our preview, that's all. Okay, this is interesting. So I just rather just what I'd rather just what's it called? Like read it myself and then speak after. So they're saying when you see SMT, the first thing what's interesting is that this SMT isn't valid until this market structure shift happens. So I'm grateful for this example in the daily time frame because it's something I can come back to because I saw it happen before anybody else. Nobody told me. I didn't, it wasn't a live stream. It wasn't a textbook. I just understood how SMT divergence worked in theory, and I saw it come out or play out in reality. So I saw this myself. This was obviously during April, which is 2 months ago. So you can see we've been looking at this for a while. This happened in April. This happened in May. And I saw it happen. This is the daily time frame, albeit, but the idea is the same. We have the lower high created. This swing low happened, and it got broken out. Now, there's not necessarily a way for us to predict that's going down unless we use external activities. I'm basically saying that SMT alone cannot tell you direction because, like I said, this could be a continuation. So, which one is actually the weaker one? Or which one's actually the manipulated one? But my idea is that once we then have this market the shift, as we do here, then we wait for the pullback to happen. So we could actually have entered this, technically speaking, on a bearish account. So for example, this is a fair value gap. Enter in here, and then the target would be over here. So just based on the daily time frame, this would have been our bias. This would have been a trade that would have entered, obviously, on the 29th of May, the 24th of June. It's a long time, right? How many months is that? May, it's only 1 month. 1 month, I 1 to 3.65. I don't know, it depends how aggressive you are, but it's about 1 to 3.5, right? What does that mean? 3 times whatever you risked on the daily time frame. I mean, in a month, you would have made. So if you risk 1%, you would have made 3%. If you risked, I don't know, 10%, you would have made 30%. So it depends. Like, this is all capital based. If you had 100 million and you risked 1 million, you would have made 3 million in a month. That is completely fine. If you had a month like that every single month, right? Obviously, it's unlikely, but let's just say that's 3% every month. That's 3 million every month. That's 36 million a year from 100 million. You make 36% of your whole investment just from these types of trades. This is institutional, how institutional money works. So the SMT is, remember, it's to spot it first. Yeah, it's the first point. It's to spot SMT. You have to spot it. Can I edit it? I can. Kind of cool, actually. So I can spot SMT by what? Looking for the divergence between the pairs. So I'm constantly looking at the relationship. Okay. Then you wait. That's the key. This word is very key because a lot of people don't do this. They see SMT and they just assume the rest. But that's not the way it works because you need to avoid fake outs. What if SMT wants to pull out? Maybe that's going to show. So that waiting is key and it's very difficult. But you then need to understand what you're waiting for. And it's literally this. The market structure shift and the displacement. A market structure shift without a displacement is not a market structure shift. It is a change of character based on theory. That's what I would call it. We are trading almost as in the blueprints or the footprints of institutional markets. The blueprints of institutional markets, or the footprints rather, is on the displacement. A market shift without displacement is a sign that the institutions are not involved. We are trading with them at all times. So we need to understand how they move. More than that, understand how they move, understand where they move. Because once we understand where, we can then attach ourselves quicker. If we don't know where they are, then how can we follow them? It's like trying to follow somebody, but you don't even know where they are. How is that even possible? It's like trying to follow a ghost. You're going to be chasing anything because a ghost You can't predict where a ghost is going to be. You can't see the evidence of a ghost. So because of that lack of evidence of a ghost, you're going to be following lack of evidence. That's what many people, traders are doing, is that they're following something they don't understand or they don't know or they don't notice. It's like trying to convince somebody of a planet or a black hole that they or trying to convince someone in space, but they can't see it. You have to show them pictures. You have to show them theory images. It's very difficult to say, oh, there's something out bigger than this planet to a child. That is, it's hard. It's easy when they can see the stars in the sky, because then you say that right there, that light you see in the night sky is a star. It's a planet far, far, far away. It's easier to convince them because they can see it. That's why so many people are having conversations about who God is, because you cannot see God in terms of his true being. And because of that, some people have disagreements, some people have different opinions because they can't see it. It's easier when you can see it, right? But just because you can't see it doesn't mean it's not true, right? You can't see oxygen, but you breathe it in. That's some faith, right? So, excuse me, SMT alone is just to see where, okay? We are seeing where institutions are involved. Because remember, to spot it is to identify hidden institutional activity. It is hidden until you see it. It's like playing hide and seek. When you're playing hide and seek as a seeker, right? There's people hiding all around a certain environment. When those people are hiding in those environments, it's up to the seeker to look for them. And the seeker will know when they found somebody, because they will know when they found somebody when they encounter the person hiding. Let's say I have my friends or my family members hiding in my house, right? They're playing hide and seek in my room or my house. How do I know I found somebody? When I see the person I'm looking for, when I see them, when I see the person. I know that my mom is hiding in the wardrobe because I can see my mom in the wardrobe. I can open the wardrobe, my mom's not there, and therefore I haven't seen my mom in the wardrobe. But the time when you identify hidden institutional activity is when you see hidden institutional activity. But to see hidden, well, no, not to see hidden, to see institutional activity, you need to know what it looks like. I can find my mom because I know what she looks like. If she's missing in a store, let's say we were walking together in a supermarket and it's a massive place and I don't know where she is, I lost her. How do I find her? By knowing what she looks like. Because there's going to be hundreds of people. There's going to be hundreds of candlesticks. There's going to be hundreds of people that look like her. There's going to be hundreds of women. I know she's a woman, so anytime I see a man, I know it's not her. There's going to be hundreds of, I know I'm black. She's going to have to be black, right? Well, for the most part. So anybody that's not white, they're Caucasian, Asian, I don't know what other skin colors are there. I know she's not darker than my skin. She's kind of fair skinned. So I know, okay, anybody that's black, but they're darker on the darker side of being black, it's not going to be her. It's going to be someone that's more fair skinned, lighter skinned. Okay, I know her height. So anybody above 6 foot, not her. Anybody below 5'5", not her. She's in between that range. And so there's characteristics of my mother. Now, there's going to be some women that by fit multiple, they pass multiple stages. And from afar, they may look like my mother. But I know it's not my mother when I look closely. So that's why it's important to understand this so that you don't get confused when it's not this and that you can then discover it because it's going to be hidden amongst. This looks like just a low. Remember? There's going to be women that look like my mom. They're going to be dark skinned. They're going to fit her height. They're going to, maybe have her mannerisms, but they're not going to have the exact detail of her face. I know what her nose looks like. I know what her freckles look like. I know where it should be. So there's going to be specific characteristics accompanied to SMT. You cannot see SMT when looking at one market alone. It is very difficult to you can assume it, but you cannot know it. That's why it's not to look for we're looking for this specifically. The same way we're looking for my mum specifically. There's gonna be things that look like her. This low, I may think, oh, that might be SMT. It might be, but it's not until I fulfill all the specific characteristics. I can see a woman that looks like my mum from afar, but it's not my mother until I know it's my mother. Why? Because it has the potential of not being my mother. And so that's a key difference or key statement, that it may look like what I'm looking for, but until I know it's what I'm looking for, it is not what I'm looking for, which is a very bold statement because the truth is it could be a mother. But how do you know? And I'll give you an example, another example. Let's say there's a child that is missing their parents, right? Or even, let me give a different example because I've done this missing thing a while. Let's say you have school, right? Primary school is a young child, you're a teacher, and you are waiting for the parent to come pick them up, they're running a little bit late. Maybe it's after school club, right? And they normally finish at 6. It's now 6:10, and you're waiting for them to come pick them up. Now, you may see at the gate of the entrance, you're held back in the classroom. From the window, you see a person waiting at the gate, looking like they're waiting for the child, and you've seen them passing the child's parents multiple times, but you haven't really spoken to them. You're quite new, right? And so you see them waiting at the gate. They look like exactly who they expect. Would you just send out the child? Absolutely not. You are going to make sure that that person knows the child, that the child knows the person, because you know that the child's safety is important. And the same way our funds are like our child. We will not want to put our money into something that looks like SMT. We want to know it's SMT. We want to know it's institutional activity. So if we're ever unsure, we don't get into the market. So that's why sometimes when we don't get into the market can still do what we expected, because it was the markets or it was the institutional blueprint, footprint. But until we know, we consider it, we don't know, because it's our baby. Our baby is important. And you'll find more often than not that it's more important that the child goes to the right person than it go to the right person 90% of the time. Because at one time you go to the wrong person, it could be the sign of danger completely. It could mess up everything. Now, that's where the example kind of deteriorates. Not deteriorates, but it can divert, because we know that we, via risk management, can mitigate that outcome. So yes, you can send that child to the person, but if you follow the person, that's risk mitigated. Or if you send the police as a convoy to take that person home and watch them 24/7, that's a risk mitigation, right? That the child's safety is safe, but that's very unrealistic in that instance, right? But the risk mitigation in the real world scenario would be that you check that that's the correct person. You check the person knows the child's name. That you ask the child if they know them from safety up close. You check the name in the system. You check with another baby teacher. You check that they know. You ask them why they're late. You ask them to call your no number to see if it matches the number in the system. There's multiple things you can do to mitigate the risk, right? To then say that you now have a report that this is the safe person's, the person's child, or the child's parent. The same way in the that we will look at the markets and we'll do our due diligence in cross-checking that our strategy lines up. Is there SMT divergence? Is this low created on this time frame? Is this the correct correlating pair? Is the correlating pair doing X, Y, Z what we expect? Then we can come up to a formulation. So now I am waffling, but this is how I learn. I learn by examples and also learn by over analyzing. Because when you over analyze a market or a concept, it becomes embedded. So this is why I'm talking a lot. But yeah, I pretty much the spot SMT and the weight from MSS and the displacement I pretty much got on the unlock. Now the third point is to enter on the fair value gap retracement, which is once price retraces into the fair value gap, take the trade in line with the bias. So that would have been this trade here. This is the fair value gap. This is in line with the bias. Remember the market shot, the shift happened. That's confirmed the SMT. We spotted it, but we confirmed it with this, and then we enter. So spot, confirm, enter. If we spot it, but it doesn't confirm it, we have now given our money to a stranger. The same way we would have given our child to a stranger. So it's not a stranger when it's confirmed. Once it's confirmed, and then we've confirmed it, we wait again. It should actually say wait for in between here. After you wait for this confirmation, you then wait for the retracement. I think that's the only thing I would personally add. The reason why I like that is because sometimes if you don't wait, you can get in here and your drawdown is ruined. It's not 1-to-1. That's ruined. So waiting helps with confirming, and waiting also helps with increasing profits. So when you time that waiting, you can be effective and efficient. If you wait too much, for example, let's say I want to wait for price to go all the way up here, you missed the whole thing. So there is going to be some risk. That's why it's risk management, because it's not about not taking risks. It's about taking calculated risks over and over again, where the numbers and odds are in your favor. That's how you become a casino. A person that doesn't wait is a gambler. A person that waits is the casino. Waiting increases your odds because every time you wait gives you an extra step of information in your favor. The time when it's not in your favor is when that information, that new information, causes a change to your money. It's no longer in your favor. Luck, on being the right side of luck, is where the information that's given for the next candlestick is in your favor in terms of profit. That's lucky, especially when you didn't wait for that. Or if it's a result of waiting and not being early. When you're waiting and you're not early, so for example, you're waiting and you get in late, it is a reward when price goes in your direction. It is a luck only when you entered early. For example, here, if price just instantly went down, that would be luck because my strategy is to get in at least halfway or the optimal entry. But it depends on what you've predetermined. Will then determine whether you're lucky or if you are rewarded. We don't rely on luck. We don't want to be lucky. We avoid luck. And we only want to be rewarded. So, yeah, that's SMT done. You can see that low being created here, that lower low here, but then here is a high high. So maybe this is just manipulation, which would show that this sweep of this low is not lower low, but a sweep, and it's confirmed by this market shift. This is not confirmed until we get that shift. Then we can confirm it. And then simplified, I like this, is SMT is basically watching pairs disagree with what they should normally agree on. And these are some good pieces of information. Now I think I can look at this. What does it mean open a new tab? And it uses my internet. What was actually the point of Lumen? It just loads slower. This is what I needed to know. The opportunities to trade the silver bullet strategy come within 3 key timings, and they are on the session 3 to 4, which is what it's 8 to 9 basically. Okay. I haven't mastered the silver bullet, but I pretty much understand. It's just basically looking for the normal entry, but just on a specific zone of time. So I kind of want to know this. And on look at weekly profiles. External range liquidity over. Wait, what? External range liquidity, internal range liquidity. Okay, let's master. So, external range liquidity is a liquidity resting above highs or below lows of range where price often reaches to take out stops before reversing. Wait, what? Okay, so he's wording it like this, where there's dealing ranges, and those ranges, the determining factor of why the external range liquidity is because normally when price reaches that area of liquidity, it signals a reversal. meaning that it's the overall target. Okay, that makes sense. The components of an extended range liquidity: equal highs, equal lows, previous day high or low, weekly, daily liquidity pools, major swing highs and lows. Internal range liquidity is liquidity found inside a range, typically around internal highs and lows, where price retraces before continuous may move. So the components of an internal range liquidity is that it within the range, fair value gaps. I don't know what that means. Oh, so it's liquidity that will be at areas within the external liquidity range, basically. So this would be okay. That makes sense. But I need to understand these equal highs, equal lows though, because when they have equal highs, equal lows, time frame matters. I need to see how this is relevant on different time frames. Because on was it EUR/GBP? Like this is the daily time frame. Obviously, this would be external liquidity. But for example, what pair it was? I saw on a smaller time frame. Like this is the 15-minute. Does this count as external liquidity just because now there's multiple touches? Because these are equal highs. So I'm wondering if this counts as external liquidity. Because this is very broad. Okay, so this external range of liquidity based on it being a daily low comes across, I'm assuming here, go further down, and then this low, I'm assuming that's this, is now another external range liquidity. Push up. What's IRL or internal range liquidity, which is this old fair value gap. From that low, we shift from here. Oh well, we have market to shift here, pull back a little bit, and then goes up into this internal range liquidity. And come back up here. Price then goes down. What's SS mean? That's in-depth analysis right there. Oh, I see, and then he followed up. So that drop is from here. Okay. That's actually really good analysis, I'm not gonna lie. I really like this. This would be good for directions. Okay, this one is a study, and that's a deep study moment. I don't know if I want to engage in that just yet, though. Let me. SMT were pretty much good, though, can't lie. Let me. We're gonna have a go through the ICT 2022 again. What else will this guy have? Have a look at this. I know they know the power three pretty well, so I'm just gonna scan through this. I need to know what type of time frame this will happen on. I'd love to see time here as well. Identify the setup during London or New York. Mark the opening price at midnight. After spotting a consolidation, wait for a rally that takes buy side liquidity. Look for markets to shift with displacement at Christopher Valley Gap. Internal retracement. Targeting sell side. The only thing I didn't like about this is didn't really talk about time as much. But I pretty much understand that. That's pretty much everything. Just his mentorship notes. This and this guy. Probably wouldn't like to use more than one person's. Get different perspectives. It was interesting. So we have consolidation here. But we didn't really close below. I think we had the market should back up. Big out though. Open here. I like how this guy ordered it. Okay, we're gonna be in here for a while. Might do most of this off stream, I'll be real, but with that, I simply want to have the episodes in one sheet. Okay, well, hold on to this file, but go through it one by one. All right, let's see. So, episode 2. This is the introduction and some examples. I'm gonna get a fan on board. Okay, I don't know if you guys can hear it. Hold on. It's pretty loud. All right, check 1, 2. All right, check 1, 2. Can you hear my fan? Can you hear my fan? Can you hear my fan? 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2. Okay, you can kind of hear it sometimes. Let me just do it one more time. 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 1, 2. Okay, it's kind of peak. Oh. 1, 2, 1, 2, 1, 2. Hello. I want to talk about something new. Hello, hello. Okay. I think I've just got to angle myself. It shouldn't be too bad. Okay. That just helped me a lot, this fan. But done with episode 2, which just simply saying that we should expect when we're looking for a price to move lower, we need to have something that's move, like price to move higher, essentially. We should expect a raid on some sell stops or short-term lows first. And that's the thing. I need to get the difference between a swing term and a short-term low. What makes And that's it's just a basic one. Mm. Yeah, makes sense. I got it now. So it is consistent that we're only looking for short-term highs, short-term lows, which is the same as a uh, STL. It was STL, ITL, LTL. So short-term low, short-term high, intermediate term high, intermediate term low, long or long-term low, long-term high. So if we're expecting a measure of stop loss on some buy stops or short-term highs, well, if we're expecting price to go lower, we should be expecting a rate on buy stops and short-term highs. And higher is over here. In consolidation, use the 1 hour chart to mark key support and resistance. These act as liquidity pools. Watch for stop hunts above or below recent highs and lows of after the liquidity sweep drop to the 2-minute chart. So if we're to look at this, for example, let's go. So this is currently an ITL, ITH, because I see a STH here and I see a STH here. So this is ITH. And it's a very strong one because it's within this fair value gap, number one. Now I need to know if it's a ITH or an LTH. So for this to be an LTH, I need 2 ITHs to either side. This is a STH, one to the left, one to the right. This is ITH. This is the STH here. STH here. So this is the ITH. This is the LTH right here. That's not straight. Way better if I use caps. Now we are bearish with the understanding that price could go up, but bearish until we take this out. We have some accumulation here. We didn't take out buy stop stuff. Or we should expect for a short-term high to be taken out. So this is a short-term high here from the market open. This short-term high did not get taken out. What did the EU do? We have a divergence, maybe. Is this a box? Oh, it's from the daily thing. But I don't like cluttered charts. For the power 3, the accumulation from the market open, which is from here. Swap the lows, swap the highs of Asian highs, swap the highs of this consolidation. We now would be expecting a pullback. The only problem is that we've reached our target. So maybe you could target this. Look at some smaller structure. This is a potentially argue it's the ITH on the 15-minute time frame because this candlestick's high is 1.14111. This is it's the same. Never mind. This is not an ITH yet. Then let me see on the small time frame. Maybe it is. Okay, on the 5-minute it is. This one's 14175. This is 14129. 14162, both of which is lower than 14175. So I'll just show you what I'm talking about. So this would be a and STH. This could also be one as well. So this now becomes an ITH. That's the best we can make it. No way could it be an LTH. So now, is this a part of a? So wait, that notes that we saw, the bonus. Does it say just fair value gaps alone? So fair value gap, all the block as well. Breaker block. So fair value gap, all the block, breaker block. I just need to know the breaker block properly. Mother trucker. Why'd she cut me? Yo, I got my finger in the fan. Oh my. Yo, this is not a good idea. Oh. She did cool on my PC though. I was actually a big cut as well. Alright, I'm back. Sorry, I put my hand in the fan by accident. I was using the fan to cool on my PC, and then that same fan, it was a very awkward position because it's a very big fan. The PC is like half open, and then my finger got caught in the blade, but it's fine. It just cut me like 3 times on one finger. There's a lot of blood, like I haven't played like that in a while, so it was painful. But for how much blood, it wasn't as painful as I thought it would be. Anyway, back to the task at hand. So I understand the concept of breaker block. I don't want to go into deep of a detail. I just want to know what it was referring to. I understand the mitigation block, which is like the first candles high of the. No, it's the open of the first candlestick contributing to the run against the bias. So in this instance, the first candlestick contributing this run against the bearish bias is this open right here. It was that level. Bearish, it'll be this level. So when price is bullish, we can come back and we can tag this mitigation block to then go to the upside. Same way, likewise, bearish, we push down, we actually can use back this mitigation block right here. So this is just us going over with the line markets, this market structure on the most recent market now. So this can be an ITH on a 5-minute, because this is a STH. This is an STH. You also have this as an STH as well. So it's not like it's the other one. This could also, oh, how do I move it? I guess I'll drag it from here. This could also be the STH we're referring to. So the point is that price shouldn't take out an ITH. This ITH is even stronger because on a larger time frame, well, actually, it's not in an order block. I was going to say this is order block, but it's not because there's no displacement. But on the 30 minutes, it's a fair value gap. Oh, sorry, I've got caps on already. So 30-minute fair value gap. Okay, I'll stop bleeding. It looks healed already. God, I healed his hand in Jesus' name. Be healed. So this ITH right here is in a 30-minute fair value gap, so it's extremely strong. STH on either side, which makes it the ITH. And whilst we're bearish, which we, I guess, can be to this weekly low right here, we can be looking for sales. Now, if you look at the power 3 as well, you can see we had this accumulation. We had this sweep into this 30-minute fair value gap, which actually created this high over here. So we took out this short-term high, basically. And then we had a market shift, taking out these, again, technically took out this short-term low right here. To did that, it broke, but it's not come up once. So in terms of from London to the London range, we do not have price at entry. So I think my entry would be probably from right here, of which price shouldn't come up and take that out, targeting this weekly low. Something like this. Look at the daily song. I think it satisfies that as well. So the daily low, let's have a look at some. This is external range right here. So how do they draw theirs? They used a thing called trend line. We have a black line. This is the daily low here. Is that bold? Extended range daily low here. Internal range. Took out this external range. How did they? So it's similar, and it's like that. The external range I drew over here came up into this internal range, and then created this opportunities. External range, let's just say this external range here came up, created this opportunity. The only thing is, I don't know if there was need to actually get in. It wasn't just delivered straight down. So the only time we can get in now is if price comes up to this entry here. But GU is a little bit behind because it didn't actually take liquidity. I'll ask that question later. So we had the range of accumulation, which didn't take any buy stops or short-term highs, and therefore there wasn't really opportunity to sell. So I was mixing this up with ranges. I need to know what range, because you have the session range from London, which is established from this orange high to this orange low. Within that, we're currently in a discount. We wait for price to come up here. I don't know if this is enough information to enter sell on GU. Oh wait, we might have SMT. Wait. Oh, from here to here. With a low high, let's create the high high. So remember, that's spotting it, but then we need to wait for the markers to shift, and then we wait for the retracement. Bro. We'll sell, pick the pair that failed to make a high high. So I should pick GU. But then EU's, this is more like a sweep than it is. I know it's a high high and it's for sell, but that's also part of the entry model. Pair that we swept. But then they said that this failed, but then this has liquidity up here. Maybe we can enter both. Or either or in this instance. Because there are many times, this is only, I don't know. Cup. So in consolidation, use the hour chart to mark support and resistance. This is not mentioned here. So he's essentially saying, well, this would be classified as support, I'm guessing. It's been a while since I traded retail, so I'm a bit rusty. I'm guessing this would be support. Maybe up here as well. Yeah, episode 3 time. There's another point I'm missing, that the market should shift. Wait, so the question I have with this is saying that market shifts only happen when liquidity is taken out. So what happens when we have the instance of a order block being confirmed? Does the order block is confirmed by a market shift, but does that market shift classify as a market shift as well, or is it just a market shift that confirms the order block? Let me see where I can find the answer to that. Hold on. Okay. In the tab I've deleted, it would be um, can hold again. Okay, this one we'll talk about it, because SMT doesn't have a liquidity sweep before the shift. Do we not have SMT? Okay, so the markers for the shift, he only drew it on the pair that actually created the lower low. So he didn't enter on this one. He entered on the one that had the sweep. So for example, that would be the equivalent of entering on EU because that had the sweep, rather than entering on GU, which didn't have the sweep, essentially. Because I have a demo account, I'll probably enter on both, but also note that the kill zone has exited. So I think the only time we would ever be able to enter now would be the New York Open. But on this SMT, the market to shift, even though this had a market to shift, they didn't use that to confirm the SMT. They used it to confirm it on the one. So, and this also had the taking of these short-term lows. No matter what time frame this is, even if it's like the 5 minute, it still took out some liquidity. But it's not detailed enough for me to create a certain method of thinking just based off of that. So I need another example. Where else do we look for market structure shifts? Order blocks, yes, but I haven't looked at order blocks today. So maybe I can look at that page, which would be this website. And then I know they've definitely done order blocks, so just have to search for it. That's a good one. This guy keep doing this. I'll have a look at all of these. So the order block. This one grabs the high and then has a structure shift. It's like there's always a market structure shift, but there's always a grab of some sort of high. Whether it's I think I closed it. Telling me a bearish order block. Oh yeah, okay. Bearish order block in a bearish market. Okay, that makes sense. I thought it was making that as a overall point. I was about to question this whole person's integrity. Wait, my blood tastes weird. Tastes very metallic. Ugh. No. Ugh. Give me a second. Where's my map? Okay, so a marker such a shift. Hmm. It's slightly different for confirming an order block and confirming a change of direction. I don't know. It's a bit weird. Because technically it does grab a short-term low, high rather, but fair enough. Go for marker for the shift. I want to know if it includes. Okay. Okay. I think I'm gonna call it right there. I'm getting to that point where it's starting to go to. I have to reread things 5 times over just for me to catch it. We must have a break. There's a lot of different aspects of things we learned today, and it's all from different kind of sides: market structure, price action, concepts, ideologies, theories. And so because they're all kind of, and I didn't really write much down, so I'm not gonna overload my brain. It's only 2 hours you've been studying for, but I'm gonna take a break and then potentially return to the markets. Hey yo, return to the markets at New York Open. Let's see what we've analyzed thus far. Plus, also it's coming up to a time where I can eat. So I'm gonna call it here, boys and girls. Thank you. This is day 101. We are currently back on studying deeper what we already know. We can gain a better grip and understanding of what we are doing. We've established clarification with some market structure today. We also understood a little bit better tape reading, to seeing how price moves from the external range liquidity towards internal range liquidity, how it manages the relationship between those two. We're seeing consolidation with the power of three, S&T divergence is coming up cleaner. I think we're gonna be prioritizing. Yeah, it's too noisy. I'll catch you guys tomorrow. CJ, I see. Peace.